Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 2nd of August. I'm Daniel Lam, your host for the podcast. Yesterday, we spoke about why this could be the time for Chinese equities to rally. But in order to get a more holistic picture, you must examine how US equities may fare as well. Now, why is that? Well, it's because of the interest rate, which is much higher nowadays than during the times of QE. And therefore, all else being equal, there is a higher opportunity cost in borrowing and for investing. Thus, instead of the rising tide lifting all boats mantra that had been prevalent during QE times, over the last 1.5 years, you would often see US and European equities going higher, while EM and Chinese equities may lag or even go lower. And of course, the vice versa may happen. And we do believe that Chinese equities is likely to outperform US equities over the near term. Now, we had previously talked about potential rotation away from US stocks, particularly in the growth-oriented sectors, and going into Chinese equities. Well, last week, foreign investors have poured into the onshore Chinese markets at their fastest pace since the first quarter this year, following the fading of the zero-COVID policy. But investors' positioning in Chinese equities is still low, and there's still room to grow. So what is the catalyst for this rotation? Well, besides the support pledged by the Politburo, it had to do with economic surprise, i.e. the actual economic data versus expectations. Now, the China Economic Surprise Index is at a rock bottom. Over the past 5 years, we only saw worst level in the first half of 2020, i.e. the time when COVID-19 broke out globally. Now, in other words, the bar is low for China data to outperform its beaten down expectations. Meanwhile, US economic surprise had been strong in the first half of this year, and that led to heightened expectations. So therefore, the bar to beat is high. In particular, there has been evidence of weakening in consumer spending. So for example, the latest FinServ US credit card spending figure has been pulling back. The spending downturn spans across both home improvement and entertainment, which is rare because usually consumers rotate the spending between these two categories. So remember that for asset prices, the key driver is how actual data comes out versus expectations. So like we said yesterday, sentiment in China had moved from extreme optimism in the first quarter of this year to extreme pessimism today. And now this process looks complete. Chinese equities have the appearance of a high convexity trade, i.e. limited downside with reasonable upside potential. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.